Hello and welcome to Chapter 6, Reporting and Analyzing Inventory. So our learning objectives from this chapter is to determine the steps for inventory quantities. We will apply the cost formula for specific identification, first in, first out, average cost under the perpetual inventory system. We will explain the effects on the financial statements by choosing each of these inventory cost formulas, and finally look at the presentation and analysis of inventory. So when we talk about inventory, so inventory is a current asset onto your balance sheet. Okay, for most companies, it does contribute to a big chunk of the total current assets. So whether the company uses the periodic system or the perpetual system, the companies do have to do the physical count of their inventory at least once a year. Okay, that is at the end of the accounting period, just to make sure that their inventory records are accurate, that there is no shrinkage. And if there is any shrinkage, then we need to account for that as we go. So when the company is taking the inventory, they need to make sure that each inventory item is properly accounted for, and the companies needs to have good internal control measures for controlling those inventory items. So counting the inventory is one of the control activities, and then we reconcile that inventory to make sure that it matches with our records and we have all the items that there should be. If you come across any shrinkage or theft when the physical count of inventory is done, then at that point in time, we will go ahead and adjust for that. Now, when we are looking at the inventory, now how do we determine the ownership? Just because you have something sitting at the property does not mean you own it. So in this case, we look at the ownership. So the ownership of the goods has to be considered and accounted for when we are taking inventory. Now think of your FOBs. So FOB shipping point or your FOB destination. Depending on which party has the legal title to those goods while they are in transit, will be the one reporting these goods as inventory items on their balance sheet. Okay, so whether that is the buyer or the seller, only one party can report those goods. So the physical presence of the goods on the property or lack of does not mean you own or you don't own that property. What governs that is the legal ownership of the goods, whether they are at the property or they are not. If you have legal title, then they would be part of your inventory account. When it comes to consignment goods, so consignment goods is where the goods are actually owned by the consignor and the consignee is just holding it on their property in order to sell and make money, which is through commission. Usually that model would work in the auto industry. Okay, so that's where the vehicles are actually manufactured and owned by the manufacturer, so they are the consignor. The consignee, the places that are selling it, they are actually just holding that inventory on their property to sell and make commission off of that. So that is a consignor-consignee relationship. The goods in that relationship are always held by the consignor, not the consignee. So even though the consignor doesn't have the physical goods on their property, they are still going to list it on their balance sheet. Any goods that are taken home on approval by a customer is still owned by the companies and hence should be reported on their balance sheet or inventory account. We will look at these couple of examples in class to determine ownership of goods. The inventory cost determination method. So once we have counted the inventory, we know how many items of a certain categories exist, then we must apply a unit price. So the end goal is when we say that our inventory is worth X on our balance sheet, where is that X coming from? So where that is coming from basically is the number of goods that you have on hand. So that is coming from your physical count multiplied with the unit cost. So what should be that unit cost? Okay. What if the prices are changing? then what cost would you determine? What cost would you use? Would you use the cost 5 months ago, or would you use the cost at the end of the year? So that is what we are discussing with the cost determination for inventory. So there are three possible ways we can go about this. One is specific identification. We have first in, first out, and the other one is weighted average. Now, these are the only three acceptable methods that we are using under the cost determination. So what specific identification does is this method follows perpetual system, and it only works in perpetual system. With the other guys, remember the two ways of doing inventory was perpetual and periodic. This method, specific identification, exists only under perpetual method. This does not exist under periodic. Okay, so this will track the physical flow of goods. So the goods coming in will be tracked and the goods going out will be tracked. This specific identification method, it's quite labor intensive. The reason being that each item is tracked by its own. So the incoming purchases are tracked by its own and the outgoing purchases are tracked by its own. So you need to have quite some detailed records if the company is using specific identification, which means it will be labor intensive. It's going to cost you money. So unless the company really sees the value in using specific identification, they should stay away from this method. Generally speaking, this is used in automobile industry where if they choose to apply this method, where the cost of each car is different, if it's very unique, okay? Or most commonly, this will be used in arts. So if you have art pieces, let's say if it's an art gallery. So art gallery has different products from different artists. Each of those items cost different and it's going to sell differently. So that is where specific identification will be a great inventory tool to use, okay? But it has to be very specific in those instances. So it does require a lot of time and effort to track them because this is real time and it tracks each item on its own. On the other hand, because specific identification is quite labor intensive and not very ideal for every type of business, the other two alternatives we have is your first in, first out, and average cost. So your first in, first out assumes that whatever goods were purchased first were sold first. So the cost of the first items purchased is the cost of the first items sold. And the inventory is made up of the newest items. Now, if you think of the chronology, let's say in the month, so whatever was purchased on, let's say you did two purchases on January 1st was the first bunch of purchases. Then we had the second purchases done on January 10th. Now, when you are selling the goods on January 15th, it will first be considered to have been sold out of the January 1st batch, and then the remainder from the January 10th batch. So first in, first out, as the name suggests. On the other end, we have an average cost method. So with the average cost method, we average the cost of purchases, okay? And we'll look at details of how to do that, but with first in, first out, we keep the cost of purchases separate as we buy them and then appropriately allocate that when we sell it. But with the average cost, we go ahead and calculate the average cost. We just average it out amongst the units available. So first in, first out, your merchandising inventory is recorded at most recent, which is your current cost, in the current section of your statement of financial position. So first in, first out also means that if you have any inventory on hand, then that inventory is coming from your most recent purchases, which will become part of your ending inventory on your statement of financial position. So that is at the most recent cost, which means that those numbers are pretty solid. On the other end, though, the cost of goods sold is recorded as an expense to the oldest items that were available. So in that case, your cost of goods sold item, your items might have been purchased a couple of months ago, when the prices were lower or higher, right? So in that case, your cost of goods sold that you have determined, those numbers are going to be based off of first in, first out. So whatever was purchased first. So your ending inventory and cost of goods sold under first in, first out are the same under periodic and perpetual. Regardless of how that is calculated, it is going to give you the same end result. The process of how we are calculating and when that information is available is different, but when it comes to the end result is the same. This is what a perpetual inventory schedule looks like. So when we are following the perpetual system, we have to come up with 3 broad categories or sections to track our purchases, track our cost of goods sold, and the balances. Balance basically is your ending inventory. So under each of this column, then we would have 3 sub-columns for units, cost, and total. So the number of units we have multiplied by cost per unit gives you the total amount. Now, if you notice here, in this case, the company had beginning inventory on January the 1st for 100 units. The cost at the time was $10 a unit, so it gives you a total of $1,000 inventory. Then we did purchases of 200 units at $11 cost on April the 15th. That gave us a total of $2,200 of purchases we purchased. Now, if you look at the ending inventory column or the balance column, both of those inventories are at a different cost. So we are going to keep them separately. We are not going to club them together. On May the 1st, the company is selling 150 units. But the way those 150 units are allocated, because we are using the first in, first out assumption, that means the first 100 units are going to come out of that January 1st units, which were at a $10 cost. The other 50 units will come out of the April 15th purchase, which was at a $11 cost. So at the end, when we are updating our ending inventory after the sale on May the 1st, your first batch from January the 1st is completely exhausted. What we are left with is April the 15th. We purchased 200 units. Out of those 200 units, 50 were sold, so we are left with 150 units. Same thing happens on August the 24th. We do another purchase, but we are keeping both of our purchases separate. Your earlier 150 units left at $11 is kept separate than these 300 units at $12. When we sell on September the 10th, we will first use the 150 units at the cost of $11, and then the other 250 units at the cost of $12. And accordingly, we update our ending inventory. So your cost of goods sold is the total of everything that you have sold during the year. So the total cost related to the May 1st sale was $1,150, and the total cost related to September 10th sale is $4,650. So in this period, we sold goods worth $6,200. Now, if you look at your purchases, we had total purchases in this period for 900 units with the total cost of $11,000. So if we had 900 units and the total cost was $11,000, then out of that we have sold 550 units. So 900 minus 550 leaves us with 350 units. But keep in mind, we also had the beginning balance or the beginning inventory of 100 units. Okay, so technically we have 1,000 units at a total cost of 12,000. Out of that, we sold 550 units. That cost us $6,200, and we are left, so 1,000 units minus 550 units that we sold, we are left with 450 units on hand with the total cost of $58,000. So that is $12,000 minus 6,200. And your numbers have to work out. It has to reconcile, otherwise your schedule is incorrect. Then we have our average cost formula. So just looking at the first in, first out, where we always keep our buckets separate because they are at a different price. Under the average cost formula, so the physical flow of inventory cannot be specifically measured. So under the perpetual inventory system, we calculate a new moving average cost every time there is a new purchase. When the goods are sold, we apply the last average cost that was calculated. So this is what your perpetual average cost calculation is going to look like. It's the same data, but with a different way to calculate. So on January the 1st, we had 100 units at $10 each, giving us $1,000 worth of inventory. On April the 15th, we have purchased 200 units at $11 each, giving us $2,200 of inventory. So as soon as you do the purchase, we are going to add up the units. So we purchased 200 units on April the 15th, and we had 100 units from the beginning. So we have total 300 units. How much money did we spend? From our beginning inventory, our money spent was $1,000. From April the 15th purchases, our money spent is $2,200. So our total cost is $3,200. So $3,200 divided by 300 units gives us per unit cost or average cost of $10.67. Now that cost is used when we sell on May the 1st. So here we don't have to distinguish those 150 units. We take the last average cost that was calculated, apply it to all of these 150 units. That's a total cost of $1,600. Out of the total inventory, we are still left with 150 units at the same average cost that was calculated earlier. That's ending inventory worth $1,600. On August the 24th, when we purchased 300 more units, now as soon as the purchase happens, we will have to recalculate our average cost. So our beginning inventory on August the 24th is 150 units at $1,600 cost. So now we have 300 units with the additional cost of $3,600. So basically we have 450 units in total with the total cost of $5,200. So $5,200 divided by 450 units gives us new average cost of $11.56. And if you see, your average cost is going up because the per unit cost every time you purchase is also increasing. And we apply the same cost of $11.56 on September the 10th when we are selling the goods. So once again, make sure that your total of purchases plus the beginning inventory minus cost of goods sold is really what your ending inventory is. So in this case as well, we are still left with the same 450 units on hand because it's the same data set. But now the average cost allocated to that inventory is $12.84, giving us ending inventory of $5,777. So the examples we will look at in class are P6-2A and 3A with regards to first in, first out and average cost method. Choosing the inventory cost formula. Now, when the companies are choosing which cost formula to go, whether with the specific identification, first in, first out, or the average cost, they have to go with the physical flow of the goods. Okay, the company cannot choose to go with the first in, first out if their physical layout of their warehouse does not support that. Okay, if you have a room and there is just one door, all the product that comes in, you just keep stacking it against the walls, there is no way you will be able to retrieve the first in, first out. The items that came in first, you won't be able to retrieve them if you don't have the layout. Okay, so these cost formulas has to actually be in line with the physical flow of goods. So whatever the company has in their warehouse is how we should go ahead and decide our cost formula. Okay, and we also want to make sure that our ending inventory reports at most recent cost. So we try to use the formulas for inventories that are similar in nature and usage. So apply the same formula if you have homogeneous group. This is a quick summary of goods and bads of all of these cost formulas. So as we said with specific identification, the only flip side of that guy is that it's quite labor intensive and it's costlier to do. But on the good side, it exactly tracks the flow of information. It has the actual movement. It has everything is real time, and the information is it's always accurate. Okay, that's the best piece of information you can get from specific identification because it exactly ties in with what product came in and what product was sold. It's just that it's labor intensive. With the first in, first out, the first in, first out is, it approximates the physical flow of the most retailers. But the good thing with this is whatever you see on your ending inventory will be at the most current prices because they are your current purchases. So they are closest to reality. But when you are calculating your cost of goods sold based on first in, first out, then that information is a little bit stale because those were old numbers. So if the prices are going up, then your cost of goods sold is lower than what it should have been. So ending inventory will be good, but cost of goods sold wouldn't be. And under the average cost method, it's easier to apply because we are averaging out the cost. So when the companies average out the cost, basically they are dealing with the peaks and valleys in their revenues and expenses. Okay, they are trying to minimize the fluctuations in their cost of goods sold item. Okay, so it will smoothen out the effect of these price changes if you are using the average cost formula. Okay, so the cost of goods sold on the income statement will include more current cost than FIFO. This is the summary of financial statement effect of these cost formulas. So with the specific identification, whether we are looking at that method in rising prices situation or the falling prices situation, it will give us a variable effect. Okay, none of these transactions have any effect on the cash. Cash is not an element here. They're not tied to cash. But let's say if we are talking about rising prices and first in, first out, in that case, as we were saying earlier, because it's first in, first out, anything that is not sold is actually coming from your most recent purchases. And that becomes part of your ending inventory. So your ending inventory number is higher if the prices are increasing. Okay, so your ending inventory number is higher. But because the ending inventory number is higher, your cost of goods sold is going to be lower because that's tied to older prices which were lower. So if your cost of goods sold is lower, that means cost of goods sold is the statement of income item. So if your cost of goods sold is lower, that means your retained earnings or your net income is higher. And that effect will exactly reverse if there was falling prices. Same idea applies to your average cost. So with the average cost, if the prices are rising, then your cost of goods sold is going to be higher. If your cost of goods sold is higher, then your net income is going to be lower. If the net income is going to be lower, eventually that net income will get to retained earnings, which will also be lower. Your ending inventory will also be lower if the prices are rising because the cost is going up. So your ending inventory is going to be lower. Okay, if you're looking at the falling prices in the average assumption, it will be exactly the opposite effect. The other concept we are exploring in this chapter is the concept of lower of cost and net realizable value, that is LCNRV. So LCNRV is when your inventory is sitting onto your financial statement, it is sitting at cost. So at the end of the period, at the end of the year, we look at that total inventory cost and compare that against the net realizable value, which necessarily is the selling price minus any cost that it will take us to sell that. Okay, so net realizable value is if I sell these goods today, what's the selling price minus any cost of disposition. Okay, so if you have to deliver those goods to someone, then you have to bear that cost. So that is your cost of disposition. So selling price minus your cost of disposition becomes your net realizable value. Our inventory has to be on the lower of those two. If your cost is lower, then you don't have to do any adjustment, but you still have to evaluate that you have applied the LCNRV rule. It has to be applied at the end of the year. If you determine that your cost is lower, then no adjustment is needed. But if your net realizable value is lower than cost, then your inventory is already sitting at cost. That means your inventory is overstated onto your books. So then we have to bring your inventory down. That is called the write down. Okay, so the write down will be a debit to cost of goods sold and credit to inventory account, but we do have to make sure that we apply this to the individual inventory item. We cannot apply this to a group. We have to apply this to individual inventory items one by one. Reporting the inventory. Now your inventory is reported onto your financial statement as a current asset, but as we said, it has to be at the lower of your cost and net realizable value. If cost is lower, then you don't have to adjust anything. But if it is net realizable value, then you have to do an adjustment and make sure your inventory is sitting on your statement of financial position at lower of cost or net realizable value. When it comes to the notes disclosure, we have to indicate the total amount of inventory, the cost of goods sold, the cost formula that was used, and if there was any write down to NRV or the reversals. Okay. When it comes to inventory reporting, there are not a whole lot of significant differences when it comes to IFRS and ASPE. So this is the example that we will look at in class with regards to our learnings. And that is all we have for chapter 6. Thank you for listening in.